Well, welcome to one of Tideway's fund manager interviews, and we're very fortunate to have Stephen Snowden with us today from Artemis. He heads up the investment team in Edinburgh that looks after the fixed income funds. We always look to try and hire the best talent we can to manage our money, so we're here today to talk to the talent and find out a little bit about Stephen, a little bit about the funds that he's running, and get some of his current views on markets, and particularly probably the key topic of the topic du jour, which is sort of interest rates and inflation looking forward. So Stephen, welcome, and tell us a little bit about what you do for Artemis and how you've arrived there.
Sure, thanks, James. So I've been at Artemis almost exactly 2 years. So I'm one of a team of 6 that arrived from Keynes Capital to set up a new bond team at Artemis. We have 4 funds, 2 high yield funds, a corporate bond fund, which we're talking mostly about today, and then a fund called the Target Return Bond Fund, which is a kind of absolute return bond fund. You know, just briefly, my history is I started investing in 1994. So I, before it was trendy or you could finance yourself around the world for a year, I left university on a Friday and I started on a Monday morning back in 1994. So I've been doing this job almost 27 years, but the first 4 years of my career was US equities before moving on to fixed income. So I started at Keynes Capital, went to Old Mutual for a few years, but the bulk of my career has been at Keynes Capital. And then 2 years ago, started off at Artemis.
Good. Well, I mean, I don't know how much you know about Tideway, but obviously we're very much in the sort of at the market, or at the retirement market. And so, you know, fixed income is a pretty important asset class for us. We've actually got more money in fixed income than we do in equities as a company overall. And I think we've been increasing our mandates with you and your team in the various funds. So I think I asked the team this morning, I think we've got about 12 million now invested in the 2 funds that we're using, and we're looking at probably introducing the Target Return Fund as well. So yeah, so I guess, you know, we just to sort of summarize, we invest, I think, in the short dated bond fund a little bit, but the one that we thought we would talk about today is the corporate bond fund, which is kind of, we have quite a lot of high yield, and that's been our specialist area historically. And you've been the only manager that we've actually trusted with to manage in the sort of more vanilla corporate bond space. And I think we got some very nice performance last year, and I should obviously give the warning that past performance is no guarantee to the future, Stephen, but do you want to just tell us a little bit about what's gone well for you in the last 12 to 18 months and why you think that's worked?
Yeah, I think it's easy to forget now, but we launched the corporate bond fund 6 weeks before the general election, when Boris Johnson had taken over leadership with the Conservative Party. Now, back in that era, Brexit was still, certainly approach to Brexit was still a little bit uncertain. You had the US and China still engaged in a multi-year long trade dispute.
Yeah.
We also have to bear in mind it wasn't an unrealistic at the time that a rainbow alliance could have been formed in Westminster if Conservatives hadn't performed well, with Labour Party run by Jeremy Corbyn and propped up by the SNP, perhaps with the support of Liberal Democrats, was not a tail risk. And that would have had material implications for a number of sectors, utilities, and to UK banks. So having launched 6 weeks before the election, we had to take a position on how we felt that would go. I thought the Conservatives would win. I thought the fears of a rainbow alliance were overplayed, but the UK banking sector was actually very weak at that moment in time. So we took the view of being long the UK banks. Now, the Conservatives won an overwhelming majority, well beyond everybody's expectations, and the UK banking sector performed well as a result. I would say at the very start of the launch of this fund, that was probably the key decision and correct decision that we had made. Whenever the pandemic hit, I would say that we got a little bit lucky. what normally happens, and we're doing this job a long time, is the market, particularly in the corporate bond market, has seasonalities. You typically get a little bit of weakness at some point in the first quarter. You also usually get a little bit of weakness around about October time. The credit market had a really strong run post the election, and you typically get the January rally. So we had a huge rally in the market, December, January. A few things were starting to look a bit expensive. We started taking a few chips off the table just for the seasonality of weakness. We did that at the start of February. Now, coronavirus was a known at that point, but not really in, I would say, in deep consciousness.
I don't think we knew quite what was coming.
Yeah, what it was going to turn out. So we took a few chips off the table just through, the market we felt looking expensive. Now that proved to be lucky, because that decision was not based on COVID. That decision was based on market valuation. That gives us a little bit of cash to work with, and then the market started to dump aggressively in mid-March. We started to buy into a falling market. Now that does take a lot of discipline, and I would say that the greatest contributor to our returns is that willingness to lose money before you make money. When the market was in free fall, you get bargains. The problem is you come in on the 15th of March, you buy a little bit, come in the 16th, it's fallen, you feel a bit stupid, you buy a bit more, come in the 17th, it's fallen more again, you're doubly stupid, you buy a bit more, 18th of March comes in, your last three purchases are all offside, but what is when the market turns,
it's going to be good.
It rallies back in the vacuum. So, the way corporate bond market works, it's not very liquid. Unless you're falling when people are selling, you don't get the opportunity to get those bargains at the bottom of the market. So, a former boss of mine used to have this phrase, don't be the first mouse in the trap, the second mouse gets the cheese. That is a great saying, but it only works in a market with perfect liquidity, and that is not the corporate bond market. So
I was going to use the analogy of catching a falling knife, which is one of the things we always try and avoid in equities. You wait for the bottom, but maybe in fixed income, where you've got more confidence that the underlying issuers aren't going bust, you just know that opportunity to acquire them is going to turn out to be really good.
Yeah, and I think that's where my experience, played out, because I've obviously been through this before, the Euro crisis, the financial crisis, obviously TMT bubble, go way back to Russia and emerging market problems in the late 90s. So the market, or certainly the corporate bond market, has incredible powers of being able to recover. And when the bargain presents itself, when the valuations get to the madness, you have to be prepared to look stupid first, which is what we did. So we were buying the bargains, the market rallied back aggressively, and then whenever the market goes through a massive shock, the way I would sort of say, when the market is strong, it's a bit like a brand new deck of playing cards. All the cards are ace, king, queen, right down to 2, all in the 4 suits, perfectly organized. But then whenever you have a shock, like we did in March last year, the cards get thrown up in the air and they all flutter down to the ground, all over the place. So you get dislocations all over the place in the credit market. And then that allowed us, bizarrely enough, and there's no theoretical reason for it, some bonds had held up really well, some had got beaten up. And these used to be bonds by the same company. So you sell the expensive one and you buy the cheap one.
It's really driven by liquidity and the market makers, isn't it?
Correct. Correct. So it's driven by liquidity. It's also driven by the different silos of buyers. So some people only buy euro-denominated bonds, some people only buy dollar-denominated bonds, some people only buy sterling, some people only buy long-dated bonds, some people only buy short-dated bonds. Some people are restricted by credit rating and a myriad of other constraints that happen a lot within the fixed income market. So you get these little islands of liquidity all over the place, which aren't really speaking to each other, and it created a great opportunity. We were able to exploit that, and then by the summertime, we had been running low COVID exposure, I would say, things like travel, leisure. We started to unwind that in the summertime. So we got to the end of October, we were then overweight airlines and pubs, transportation. Now, the evidence was coming through quite clear that a vaccine was highly likely and was quite imminent, but it wasn't until the first or second week of November that we got the announcement that Pfizer had passed the trials, and then obviously that's where COVID exposure area rallied aggressively. And then I think the last good trade that we've made would be around duration. The government bond market, and particularly the gilt market, continued to rally right through Christmas into the year end. And that made no sense to us, because at that point, the Brexit deal had been concluded. Now, we can have an argument all day long about the strength or validity of that deal, but the deal was done. It removed the degree of uncertainty. The vaccine was there. It was quite clear the economy was going to bounce back aggressively, because we'd seen what happened in the summer 6 months earlier. Yet the gilt market was still trading extremely low gilt yields. So we took a large duration position. We went short the market on the 30th of December. Now, again, you never get your timing right. If I'd waited until the morning of the 3rd of January, whatever, or the 1st of it had a little final rally before it then dramatically sold off. And so that's been I would say the dominant driver of returns.
So, I mean, I think, obviously we've got very low corporate bond yields now. So, I think you tell me if I'm wrong, but I mean, I think on the kind of average bonds that you're looking at in the market that you're actively investing, the yields are probably about 2.5%, 3%.
Yeah.
So, after fees and to get our clients the inflation plus returns that we're trying to deliver, we're relying on you, Stephen, to do some clever active management. So, we're not going to get the returns we want by just passively holding a bunch of bonds through to maturity. Which, we're looking for active management, which perhaps, is a good sort of segue into how you see things now. We've obviously got this dilemma as to whether inflation's coming and where the opportunities are looking forwards from here.
So, James, I'll take that question in two parts. First of all,
please do,
I think the power of active
off script, Stephen, but I'm sure.
Yeah, sure. The power of active management is required in fixed income. Because we can all take a view on Tesla or Apple or Amazon, and maybe the shares double or triple again. That could easily happen. I'm not the expert. I'll let other wiser people opine on that. What I do know is there's not a single bond in my portfolio is going to double. And bonds have a finite value, and our fund is benchmarked against the index, but we're not condemned to own the index. We're not condemned to sit on a bond. And as I said before, there's islands of liquidity, and people have silos, and you end up with all these disconnects across the bond market. And why wouldn't you exploit those? And what we've seen certainly over the last 1, 3, and 5 years, the passive vehicles have all underperformed the average fund. So even the average fund is outperforming the passive vehicles. So I think it's a strong endorsement of the requirements for active management within the fixed income space. In terms of where do we go from here, every bond manager gets asked the question about inflation, but inflation is a plague on everybody's house. If you've got a vintage E-type Jag in the garage, unless say it's worth £100,000, unless it's worth £103,000 next year, in real terms, you've lost money. Another problem with an asset like that is obviously it requires quite a lot of servicing. Now, you get enjoyment from the asset as well, but the point is, whether you've got a Van Gogh on the wall or a gilt in your portfolio, all assets, your house, everything, vintage wine, is all impacted by inflation. So inflation is a negative tax on every single asset class in the world. And so I think whenever you look at bonds, I don't think people should look at inflation and bonds and then forget about inflation. They need to think about inflation holistically. And then the next point is, what's the alternative? Cash is giving you zero.
Absolutely, yeah.
And there is term deposits that give, better yields. I know that, but they come with restrictions and all the rest of it. In terms of where I think the bond market's going from here, bond yields are going to be very low for a very long period of time. The central banks will continue to be involved. If you look at the way that the political debate has went, not only in this country, but around the world, society have said they have no intention of living within their means. So there is a desire to consume more than we produce, and the government makes good that shortfall with large budget deficits, which are then in turn facilitated by quantitative easing, which is an invisible taxation because it debases the value of wealth. Now that is the social contract that we are all in at the minute, and that is that's not bond specific. So bond yields will stay low; they're materially higher than cash. In terms of where I think bond yields can go from here, we are short-term negative because we are going to get some interesting inflation prints. We had one today; it wasn't that dramatic, but they will be higher.
There was one last week in the US of 4%.
Yeah, so there is. But we have to remember there's the pig passing through the python effect here.
You've got two ends of the 1 year view, and if it's the back end that was moving around rather than the front end. Yeah,
correct. So once that all passes through, I think what you'll find is that the pandemic is going to create some aspects of bottlenecks. And the global supply chain was well known to be not disarray is the wrong word, but misplaced because of the reduction in global trade and PPE coming from China, and like the containers and container ships are all in the wrong places at the wrong time. So it was always known. The FT have been reporting on this for a very long time about there would be a spike in container shipping rates, and we're seeing that. And it is hard to get people back from furlough into less glamorous jobs like flipping burgers at McDonald's. There are isolated pockets of inflation, but what we have to bear in mind is I do not believe the pandemic has fundamentally changed the key structural drivers of low inflation in the economy. One, that the adoption of technology is deflationary, the aging population is deflationary, and also we've already started off at this point with a very high debt burden. So where we can clearly continue to increase our debt burden, that massive growth impulse that we got through Tony Blair's era as Prime Minister, you just don't get that again. So growth will be structurally lower, which means inflation will be structurally lower.
There's some really good points there. I mean, I think from a planning perspective, when we're talking to clients, I mean, what you're seeing, I'm just doing advising somebody at the moment, you've got a huge price for 7-day notice liquidity. I mean, if you want 7-day notice liquidity, you're basically getting zero return. And as you say, with after inflation, with potentially what we've got going on at the moment, you might have a negative 2 or 3% return going on. Whereas in your world, you can still make that 2 or 3%. So at least we're keeping pace with inflation. And I think we're very much share your view, and also our analyst T.S. Lombard, who we use for some of the sort of macro views of the world, they're very much on your side, that the long-term drivers of low rates and low inflation are still very much in place, which is good. So okay, well, we've done about 20 minutes, Stephen. So is there anything else particularly that you would like to talk about? We mentioned passive market and active market. I think we're completely with you on that. So I think you're preaching to the converted to us on that. We're well aware of the.
I think just one aspect, if I could jump in on the passive funds, and I know that the annual management charge is cheaper, and that much is true. But I think what we've seen is not only is there short to medium term are they underperforming the average fund, but I think the transaction costs with some of the passive vehicles is actually quite high, and particularly around bond ETFs. ETFs work at their best when they are investing in very liquid, highly liquid assets. So the S&P 500, for example, US equities, extremely liquid market. The further you down the liquidity spectrum you go, the more difficult it becomes to replicate the index, and the more difficult it is to buy those bonds at a sensible price. And we've seen some very large transaction costs in passive vehicles. So when people look at the cost of the passive fixed income vehicle, they have to not only look at the annual cost, but the transaction cost, and the transaction costs are harder to see. But the actual real life holding experience of walking a mile in a passive vehicle's shoes is much more expensive than the headline figure would suggest.
No, it's very clear to us that the gap in performance between those passive funds and your kind of funds is just both systematic. Long term you can see it, short term you can see it. So we're definitely we bought into the active process. Well, that's brilliant, and thank you very much for your time today. I hope that wasn't too much out of your schedule, and we'll let you get back to your Bloomberg screen.
No, it's a pleasure speaking to you, James. I think more more people should have these types of chats, because I do think, you can tease out some interesting
Well, it's
political discussion.
One thing, we do talk about the talent that we hire, and I think you've got about 6 people working for you in the team there. Yeah. So when we multiply that out across the funds that we own, we've probably got literally hundreds of people working on each client's portfolio, and that is going on behind the scenes, and people don't see it. So it's actually quite nice for people to see into one aspect of that, and to meet you this morning. That's great.
Because philosophically, just to make that point, I mean, I'm a fund manager who invests in other funds, not in direct stocks, because I'm thinking to myself, I see how hard my colleagues are working, poring over specific areas of the market.
Yeah.
I pay them 0.5% a year, or whatever the case may be, for them to do that for me. And I think, why would I spend my time amateurishly stumbling into an area of their expertise?
Yes.
And on the hope that I can do a better job than they can.
So
I've long since given up the concept of PA investing, so I just put it into other funds, and get myself some lighter time back in my life.
And I do think as well, we're not here to talk about the equity indices, but we have had a long period where, because of those US growth stocks, indices, the MSCI World Index, S&P 500 Index, NASDAQ, been really tough to beat. But that world has changed. There's no question about that. Since that November, I was actually at sea in November when the announcement was made. I think we got a new president and a vaccine all in about 3 or 4 days.
Yeah.
And it really has been a seismic shift from then on. And we can definitely see now the active management really starting to reap some nice beta, I think we call it, or is it alpha? I never remember which one it is, but they're outperforming the indexes anyway. That's brilliant. Great.
Thank you, James.
No problem. Take care.
Thank you. Bye-bye. Been a pleasure. Thank you. Bye-bye.